It's likely that you're familiar with the terms stocks and bonds, but do you know what they actually mean? Welcome to my channel. I'm Rich Mogul, and today we'll compare stocks and bonds, see what are their similarities and differences, and help you decide which investment is better for you and your future. Before we start, don't forget to subscribe to my channel and click the notification bell so you're always first to learn how to invest and make money. Stocks and bonds are two examples of different types of investments that can be held within a diversified portfolio. When you buy stocks or bonds with the intention of earning a return, which means that over the course of time, you will have more money than you initially invested, you are said to have made an investment. However, stocks and bonds are two very distinct things that fulfill distinct functions within the context of a diversified investment portfolio. What exactly are stocks? Purchasing stocks is a form of direct investment in a company. When you invest in a company by purchasing its stock, you are essentially investing in a portion of that company. You can think of it as literally owning a piece of the company. That means that as the value of the company as it is measured in the stock market rises, so will your proportionate share of that value. On the other hand, if the value drops, it will have a negative impact on the value of your stock. You will be eligible to receive a dividend if the company realizes a significant profit and chooses to distribute some of that profit to its owners. What exactly are bonds? Bonds are an investment in debt. Bonds, which are essentially very small loans made to large entities, are a method of financing that can be utilized by both corporations and governments. For instance, if a municipality needs funds for a park, it can sell bonds now and pay the purchasers back with interest at a later date. You hand over the necessary funds to the city, which are typically only a portion of the total, and over the course of time, the city will pay you back with interest. You have the option of keeping the bond in your possession and getting the principal amount back at some point in the future, or you can choose to sell it to another party early. Stocks versus bonds. What are the benefits and drawbacks of investing in stocks as opposed to bonds? And which type of investment should you prioritize more, stocks or bonds? Let's take a look at how each one functions. Stocks. If you were interested in the possibility of earning a higher return on your investment, you should probably look into stocks. But there is an increased likelihood of loss along with the increased potential for gain. The price of stocks follows the movement of the market. Let's say you invested $1,000 in a small technology company that specializes in the sale of products online, and we'll call it Rainforest. In the subsequent 15 years, Rainforest will become a well-known brand that generates annual revenue in the billions of dollars. The company's stock saw a 100-fold increase in value. You might be able to sell your stock and make $100,000 from the transaction. On the other hand, there is always a chance that the share price will go down below what you paid for it, or that the company in which you invest will go out of business in a year, leaving you with no return on your investment. Bonds. Investment-grade bonds and U.S. government bonds are safe investments. They make regular interest payments over time, also called coupon payments, and it's unlikely they'll disappear before the debt plus interest maturity date. Consider investing $1,000 in corporate bonds. The company will pay you 4% annually for 10 years. Unless the company declares bankruptcy or runs into financial trouble, you'll likely get $1,400 after 10 years. The company's promise won't be fulfilled. Bonds are safer than stocks, so you won't get a high return. Bonds are a debt the company owes you, not an investment, so their interest and value are not affected by the company's stock price. Bond prices and yields move opposite of interest rates. If interest rates rise, you can sell your bonds for less. A $1,000 bond might sell for $900 because investors can buy new bonds with higher rates. What makes a bond different from stocks? Bonds are investments in debt, while stocks are a way to buy a piece of a company. Both can be referred to as investments. Both stocks and bonds come with varying degrees of potential loss as well as returns on investment. Let's take a look at the benefits and drawbacks of investing in each of these options. Pros and cons of stocks. Due to the fact that stocks have the potential to generate significant returns after an extended period of time, they can be considered to be high-reward investments. They have a pattern of growing in tandem with the economy and can assist in outpacing inflation. It is simpler to incur financial losses when investing in stocks due to the higher level of risk associated with these securities, and this is especially true when investing in individual stocks. Pros and cons of bonds. Bonds, on average, are considered to be investments with a lower level of risk than stocks, and they frequently provide a higher interest rate than you could obtain by placing your money in the bank. The disadvantage is that they do not provide a lot of benefits, and the interest payments might not even keep up with the rate of inflation. Because the majority of bonds are sold in increments of $1,000, which means there is a higher barrier to entry. The price of bonds is typically higher than the price of stocks. The possibility of default is inherent in lower-rated bonds, also known as junk bonds. Putting money into stocks and bonds. In the end, the best strategies for investing utilize a combination of stocks and bonds, and occasionally other alternatives such as cash, commodities, or real estate, to strike a balance between the potential for loss and the potential for gain. You also do not have to invest directly in individual stocks and bonds. There are other options. You also have the option of purchasing funds such as mutual funds or exchange-traded funds, which will invest your money for you in a diverse range of stocks, bonds, and alternative investments. When you are getting closer to the time of your retirement, you should typically have a larger percentage of your portfolio invested in stable assets such as bonds. Have a conversation with a financial advisor to ensure that you are on track to enjoy a comfortable retirement. If you want to learn more, don't forget to subscribe to my channel and click the notification bell so you're the first to see my new videos.